All right, so mentioned just a few minutes ago about the S&P breaking down a little bit here, and I do want to highlight that the NASDAQ, and I'm looking at the triple Qs right here, and they are breaking down through yesterday's low. So I think that's a good time to bring in Tech Trader. How's that for timing?
That's good timing. And
Yes.
sentiment is not looking super good here, I have to say.
Okay, so what are you seeing?
Well, it's sort of a precursor to a setup, and it'll probably lead into our conversation. But I think that, one of the things I've been looking at the last couple of weeks is the fact that complacency is like low to incredibly low. So we don't have one of these crystal clear kind of top boom type setups, but it's like it's winding up. I mean, put it this way: if this were next week, I'm just guessing. I may be making one of my correction calls again. I'm not 100% sure about it. Kind of I've hit like 5 or 6 of these, maybe even more. 400, 500, 600 NASDAQ points lower, something like that. I don't know. Maybe today is the start of it. I still don't have much concern, and there's only about 5 people on the planet who buy stocks like I do. So most people don't like cheap stocks anymore. So I think if you're buying super cheap stocks or stocks with high beta, small mid cap stocks, I don't have a ton of concern about being long or adding the longs in those. But anything that's been pushing the indices higher is looking a lot more vulnerable. And certain stats that are growing more concerning would be things like the percent of stocks over certain moving averages. One I like is the bullish percent index for technology sector. It's pretty much exactly where it was before we had the last sort of mini cloud shemizing. I mean, it didn't last very long, but there was a day where almost every cloud stock was down like 5 to 7%, and it was basically is when we had the last kind of NASDAQ correction that preceded the June low. So bullish percent on tech is like 91.2% as of last night. It's only been a little bit higher once this year, and that was about 2-3 weeks before the last pretty decent correction. So again, we're kind of queuing one up. It's kind of what I talked about last time. It's like, what sells off, and then do we actually get the stuff that sells off that is the most egregiously overvalued, or does it kind of take everything down? So that's the thing. You never know sort of the texture of the market you never know the texture of a sell-off or a correction until it's kind of started. And then you kind of can see what's developing, what's selling off, what's not, things like that. But yeah, there's definitely, a lot of times people think too that certain things, the biggest corrections come from, the most severe overbought readings. Actually, they really don't. They usually come when the overbought readings start producing lower highs. So for example, you get an extreme high on various, technical measures of overboughtness of the market, and they keep going up and hitting high points, but the highs are lower highs. It's kind of like a stock chart, like a lot of times you get the most dangerous, the biggest sell-offs in stocks, not from the high, but from like the third high. The third lower high, something like that, or the fourth lower high. Sentiment works the same way a lot of times. Like you get a really big spike, you get a little tester, but the market kind of keeps spooling higher. Then sentiment winds up again, but it goes to a lower high, and so that's kind of what we're seeing. We're kind of at a lower high, if you will, would be a good way to describe various sentiment readings I'm looking at right now. But I think I'll just wind up and go into the texture of the quarter and the earnings reports. We have Netflix coming. Netflix, a lot of people try to kind of say Netflix is a make or breaker for the quarter. It's really not. I don't think there's much correlation. The quarters Netflix has dropped a lot versus the quarters it's gone up a lot. Has it really led? Has it been a precursor? Or has it led the NASDAQ? I would say it really hasn't. It's more of a random thing. Netflix doesn't beat every single quarter. They do miss once in a while. The biggest issue is their misses have been, largely forgiven for a couple of years. And their beats have probably been overly magnified. And, they're starting to lose a lot of content, meaning it's not happening today, but in the future, a lot less content, especially premium content, is going to be on their site, and it's going to be on different people's properties. So, so at what point does that matter? But at least that, that gives us a signal, how the response is to Netflix. And then a day later, we get CrowdStrike and we get Microsoft and stuff like that. But I would say the biggest thing I would say before I hand the mic over is I just don't know if I've seen things this complacent for a long time. Nobody seems to care that stocks are this expensive. People are still buying them on any little dips. Instead of waiting for a 20-point dip in an expensive stock, they might only wait for a $4 dip, in a $200 stock and stuff like that. And so, that's what we have to see. We kind of have to see, is this the quarter where you start kind of dishing out some deserved punishment on maybe beats that aren't that exciting? Last quarter it was sort of like any beat that was a beat, especially with the high growth stocks or the most expensive high growth stocks, as long as it was a beat, or as long as it was a mildly raised guide, the stocks went up. I mean, I wasn't joking when I think it was the last time or 2 times ago when I said, there were stocks that literally gained billions of dollars of market cap on roughly $5 to $7 million in revenue beat on the quarter, meaning a combination of the quarterly beat plus the guidance raise for next quarter. Let's call it $7 million. Okay, stock's already been in the billions. Market cap goes up by 1 or 2 billion on $7 million. So, we've seen that a lot of times. So we'll just have to kind of see what happens. But I would say complacency is, you can't really measure it exactly, but it's pretty darn close to max.
So would Netflix fall into the category of they really have to hit on this quarter? Like it almost has to be a perfect quarter for it to be a sustainable bull move higher? And does that set up for a greater risk? If not Netflix, then what are some others that do have that type of profile?
Well, Netflix certainly, again, this has just been a kind of a weird stock. Yeah, I mean, you could say it. I mean, the interesting thing about Netflix is the stock, again, it almost kind of looks like how Tesla looked before Tesla finally, there'd been so many reasons for Tesla to have a big drop before it finally did post a big drop. A big drop, especially that hooked in and went lower and stayed low. I mean, Tesla's $150 below the highs. So, Netflix kind of has that look. Like, I mean, if you would have bought the stock, in the December sell-off and sold it on, January 15th, you basically haven't missed anything. So if you've held the stock since January 15th and haven't traded it, you really haven't gotten paid anything. So it's been more of a big sideways move. But they've had, if I'm not mistaken, they had 1 or 2 quarters already this year which really weren't that exciting, and yet people bought the dip. So we'll have to see. I would almost say, instead of saying, do they need a perfect print? They probably need a perfect print to go up the next day, put it that way. But it's more, how does the stock trade over 1 or 2 or 3 weeks? I would say the stuff that I've sort of maligned the most, all these cloud stocks that are the most expensive, egregiously expensive, again, most expensive stocks we've seen since '99. I would say they need perfect reports. And here's the funny thing. By and large, they sort of had perfect reports the last quarter or two. At least most of them did. Were they as good as they should have been relative to the rise in the stocks? I don't think they really were that good. I mean, my read on a lot of the quarters was second derivative growth is slowing. Again, nobody seems to care. just again the magnitude of the beats, the magnitude of the beats in Q1. Like these stocks deserve to go up in Q1, as expensive as they were, but they'd already come off a lot in Q4 last year. Some of them had only mildly recovered, and then they were producing blowout. Like the magnitude of the beats were very, very pronounced in Q1. So hey, give them their due. They got me. I owned some of them back then. And so, the magnitude of the beats were great 2 quarters ago. And here we are coming into Q3. Last quarter, magnitude of the beats really weren't that good, but it sort of seemed like last quarter nobody really cared. As long as it was a beat and raise, even if it was a relatively mild beat and raise, the stocks went up. I mean, again, Adobe went up a ton, if I remember, on a quarter that was barely beat and raise. I mean, it was just kind of good enough, but it was almost treated like it was a huge beat. So I would say, the IGB components, the cloud names. I mean, CrowdStrike is reporting now. CrowdStrike has an advantage, not on valuation, but they're a young IPO. So they probably will post pretty good. Like the magnitude of the beat's probably going to be pretty good. The relative outperformance, they probably won't be showing. I'd be surprised if they start showing second derivative growth slowing, things like that. I'm more talking about the kind of the old school, new school. So, the names that have been around for a couple years now, Okta would be a good example. A Paycom would be another example. A Zscaler would be, even though it's a little younger, that'd be a good example. I mean, Roku at 110, 111, that's kind of weird. I mean, so I mean that stock was $32 in December. So there's quite a few that I would say need that perfect report that you had just mentioned.
All right. So outside of the cloud stocks, you and I had talked about Domino's Pizza offline just a little bit here, and you said that you were surprised that this one's not actually even lower. So they had
now it's actually dropped a lot. So when you and I were texting, the stock was I want to say 260 roughly.
Okay. All right.
At least that's where it was, 260 last I looked at it, and I was sort of like, okay, I'm kind of surprised not down more. Well, it's 249 right now. So it's actually, I mean, again, this has been a darling. In its space, it's basically been an anointed stock. It's kind of, again, a bubble is overused. Is this a bubble type name? I wouldn't call the valuation a bubble valuation. Although on relative valuation metrics, if you compare this with sort of fast casual, I mean, there's basically only 2 names that have really garnered market cap, and CMG and Domino's. And it's the group. Everything else in the group is kind of hated. Del Taco, which is Taco, TACO. That's done okay, but that was a super cheap. I mean, it's still like I'm sure Taco on relative valuation metrics probably trades like a 60 or 70% discount to Domino's, even though it's double or something like. But that's kind of what you see in the space. You literally have companies that are. I don't know if the algos want to make people think that they're going to go bankrupt or something, but you have these stocks that literally go down for months, quarters, even years, even though they're kind of sideways performers. Like, okay, 2%, 3% same store sales growth, revenue growth, blah blah blah. I mean, it's kind of like Domino's, 3-4%. Oh, by the way, the stock has gone down, from 15 to 5. And that, that's what I talk about, how market structure is so screwed up for a lot of small mid-cap publicly traded companies. But the bottom line is it kind of makes sense. It's the same thing we see in this market. It's the same thing that we see how stocks trade every day. They anoint a few go up a lot, garner all the market cap, and everything else that should just, let's say, trade sideways, trades lower. That's because they're just being rated down. Or there's just no volume, so therefore any selling's front run and all that kind of. It's all the stuff that we've talked about 100 times, or lots of other people have talked about. Lee Cooperman's talked about how dumb it is that they eliminated the uptick rule, for example. And he every time he's on CNBC he talks about that. So he and I totally agree on stuff like that. But at the end of the day, for whatever reason, whatever the market rules are set up to be, the market cap kind of tends to go to a very small number of names at each group. And so Domino's and CMG have garnered kind of all the market cap in fast casual, which doesn't really make any sense because there's plenty of other companies in that space that are doing fine. I don't know if anybody's really doing great. CMG was certainly doing great years ago. I don't know. I'll look at their numbers this quarter. They've had a good turn off of their dismal numbers. But anyway, I don't want to spend too much time on Domino's because not a stock I'm going to focus on a whole lot. But I don't know. I mean, I might add it to my short list, and I might if the thing shows a good ability to kind of bounce, kind of like it does a lot. None of the numbers they're produced are inspiring. By the way, I just don't think the product's very good anymore. I mean, there was a time where I think their product for the price was pretty good, and maybe even top tier. At this point, I don't really know. I mean, I don't eat it a whole lot. But what I have, the product that I've eaten in recent years, I've been very unimpressed with, even at a really cheap price point. And so, and there's so many good sort of small chains popping up that compete with them. So, I just don't know how long they can kind of serve, a mediocre product and garner a premium multiple. We'll see. I mean, we'll see what happens. But I think it's a good testament. It's another perfect sort of example of just how mispriced stocks are. You have a small number of winners, and they're extreme winners, and they're very, very overvalued. And then you might have quite a few names that are extremely undervalued, but you just don't know when they're going to move and when things are going to regress to a valuation that makes more sense. So, but yeah, I mean, the fact that Domino's is down this much, it could be a little bit of a canary in a coal mine. I don't think you want to make too much out of it, but it could be a little bit of a tell. We'll see.
All right then. So another thing that we wanted to highlight was ACIA. Now this one got acquired last week, and you seem to think there might be another ACIA. What's the next ACIA out there for us?
Well, yeah, there's always more because there's always companies that are selling cheap, and there's always companies getting bought out. I mainly just want to highlight it that I've had a fair number of questions on this. Hey, what's next? Or hey, I'll if I have one I think is my next one, I'll definitely post. But in a way, I think I've posted a lot of this stuff. I mean, I think a lot of names. So I'm going to highlight a post that I wrote up on the remaining players in 5G optics, etc. I think I posted last Friday. And I think that the group, hey, several names I own right now could be the next one. IIVI could be. LITE could be, CASA Systems could be, heck, a Bloom Energy could be, even though it's not a 5G name. I'm just saying, why does Bloom trade where it's trading? I mean, that's a weird name just to throw just kind of a weird oddity out. There's plenty of companies producing really good results, and they just garner zero attention. And if they garner zero attention, then they're kind of algoed lower. They're not algoed sideways; they're algoed lower. But yeah, I mean, I think there's plenty of names. I mean, MTSI could get bought out. In fact, that's my single biggest concern about MTSI at this point is they get bought out and they accept a price that I think undervalues the company. Just as I firmly believe ACIA accepted a price that materially undervalues the company. But yeah, CommScope could be, although CommScope shouldn't get bought out. They're more of an acquirer. In fact, they just did a big deal, acquired, it's probably worth talking about. So their acquisition of Eris doubled their revenue. This is not a small revenue base. I mean, this is a $10-11 billion revenue base. Eris doubled the revenue base. Yet the market cap for COMM, all it's done is go down. I think it's around $3 billion or under $3 billion. So a company they acquired was doing $4.5 to $5 billion in revenue. Doesn't seem to matter. That doesn't seem to have impacted the market cap. So again, they're literally trading at 0.35 or 0.3 times sales. That's pretty weird. You know, that's not just a little weird. That's pretty weird. You know, that's equally as weird as probably Roku or Mongo or Zscaler or Okta trading at their respective highs. I mean, it's just again, it's the way this market is right now. So, you know, and have we seen things like this in the past? Yeah, but you know, we see a lot more of this today. I mean, we see this hundreds of times a year now, where a CommScope trading at 0.3 times sales after acquiring 4.5 to 5 billion revenues, and by the way, I don't think they overpaid for those revenues. They probably paid 1.5 times sales or something for them. Really bolstered their 5G portfolio a hell of a lot. You know, I mean, in 2012, I could find, you know, maybe one or two names trading that weirdly. Yahoo was one. You know, that was a big name of mine. You know, I was buying it between 12, 13, 14, 17 bucks. I calculated the value at 45. No brainer. That was just on Alibaba assets. You know, lo and behold, Alibaba IPO'd 18 months later, 2 years later, it was 45, 50 bucks. So the difference between now, the 2012 and today is, you know, 2012 it was kind of hard to find things like that, and the assets kind of had to be hidden. It had to be, well, you had to believe that Alibaba's IPO would be okay, or you had to believe that they'd have good receptivity in the U.S. marketplace. Again, the numbers were the numbers. Alibaba's numbers, there was quite a few numbers disclosing what the valuation range of that stock would be and things like that. I mean, Facebook was really weird. You know, Facebook getting down as cheap as it got down, literally 5 times net cash at one point. Again, that was really, but there wasn't 20 or 30 or 40 Facebooks. There was one. You know, like I say now, you can do a lot of screens, find all sorts of companies trading at just these ridiculously low valuations today. So, but yeah, I mean, CommScope could be a name. I mean, you know, CommScope is, yeah, somebody had mentioned this. This is a name which could be it could be a focus list name. For a while I wasn't, you know, the thing I don't like about it, the stuff I usually put in my focus list, I like growth. I like growth at good prices. CommScope's not really a perennial grower. They're more of a kind of a cash flow producer. Their revenues would probably be somewhat flat, but they acquire revenues cheap, they cash flow them out. You know, it's almost like a synergy story. It's kind of like almost a mini version of what Berkshire Hathaway does. They don't tend to buy high growth companies. They buy companies that cash flow really well. Then they redeploy their cash flow. So this is a good example of a company kind of doing that in a mini way. You know, they buy an adjacent company with really good cash flow. They can develop a lot of synergies, and the cash flows, you know, will produce this, you know, a lot of money to do stuff with for the company over time. But yeah, I mean, like I say, a very, very just tremendously undervalued set of assets that they have at this point. So, like I say, I don't know if I really have to make a big to do and say, hey, LITE is my next Acacia or COMM is my next Acacia. It could be heck, about half of everything I write about could be the next Acacia, quite frankly, because I've had quite a few companies get bought out since my time at Briefing, and I've had lots of companies get bought out since I've been a professional trader. I mean, it's kind of every year I have anywhere from 5 to 10 portfolio holdings, that somewhere in that range, that either get bought out or get M&A interest. But yeah, I think the biggest thing to keep in mind is that, and again, I'd encourage everybody to go read this post because it's almost more of a research piece than like sort of an actionable, you know, hey, here's something to do right now. But the research piece component of it's very simple. It's I think people have underestimating the amount of consolidation that's taking place in fiber optics. And one of the key determinants that made, for example, Micron be such a successful company was the rationalization in that particular part of the chip segment. They bought Elpida, Western Digital bought assets, Seagate bought assets. So basically people bought sort of the price dumper, the poor players, you know, so they consolidated poor performers, they consolidated good cash flow generators on the cheap, And lo and behold, look at the DRAM memory space today versus what it was like in 2012. Micron was a $6 stock in 2012, and Elpida was a long-term price dumper of product for a couple years back then. Well, Micron took Elpida out and basically changed the group. In fact, two big deals. Western Digital did a deal. I can't remember exactly what it was now. I think it was I think they bought a division of a Japanese company, and Micron bought Elpida, and pretty much that changed the memory industry from that day on. I could argue that LITE's buy of Aclaro, IIVI's buy of Finisar, and there's been quite a few deals. Ciena's been a net acquirer for a number of years. LITE's been a net acquirer for a number of years. IIVI has largely built a lot of their growth on strategic M&A. So at this point in time, there's not a ton of publicly traded fiber optics companies. There's really not. I mean, in the mid 90s there were a few. By the time we got to 99 to 2001, there was like way too many, 20 or 30. I don't even know how many. A few went away just because of bad business. They didn't raise enough cash at stock market highs, so they went away. They kind of self-dissolved, if you will. The good assets were bought up by the stronger players, and today there's just not that many players. Yet the stocks haven't really acted like there's not many players. Again, this is a huge reason why Avago and Skyworks and ADI and Texas Instruments have all been incredibly good performers, is due to industry consolidation in the semiconductor space. Same thing, Lam, KLAC, they used to compete with 10 other companies. Now it seems like there's only 2 or 3 companies. There's like Lam, KLAC, and there's still a few small guys. But there used to be about 4 or 5 or 6 kind of companies relatively the same size beating each other up all the time. Now you don't have that. Now you don't have that anymore. I think fiber optic industry, the photonics industry, in many ways is going to do the same thing. And so again, you have Acacia being bought. That's another player that's taken out. So that's generally long-term bullish to very bullish. It's not something you can say, oh, this is going to be great for the next 6 weeks. It's more like, hey, this could be really good for the next 6 quarters to 2 to 3 years. So, but I would stress that there's definitely more Acacias out there, but they're not an Okta. They're going to be in names that have been beaten up and then sold off and are cheap and are underappreciated. But yeah, I mean, there's just not this space is interesting now, and especially with again, are we even in any one of 5G deployment cycle? We were getting very close to it. The Huawei blacklist, I think, set us back into kind of pregame mode. So we'll just have to kind of see what happens. But I think this 5G cycle is going to be very interesting with a much smaller number of publicly traded companies participating in the moves. So, and I literally, you look at the way the stocks are trading. None of them have gotten forgiveness for misses or guide lower or things like that. I mean, Acacia mysteriously went from 60 to 45 on nothing, on no bad news. I mean, I guess it did that because Huawei was blacklisted, even though Acacia has less than 1.5% exposure to Huawei. So if you can explain that to me, well, I can explain it. It's because Cisco bought them for 70 and they wanted $70 price point to look good. So there's your conspiracy answer. But no, people overreacted for whatever reason. There might have been a little conspiratorial setup there, but I think most of the people just kind of shot everything that was involved in 5G fiber optics on the Huawei blacklist, whether they had exposure or not. And so, again, Acacia goes from 60 to 45, and it benefits Cisco very handsomely. But yeah, I think this could be a big long-tailed story. By the way, it's sometimes hard to appreciate these, but I talked about Micron very favorably in 2012 and 13. I wasn't a briefing at the time, but that stock's been a pretty good stock since then. It's had some big ups and big downs, but from $6, it's kind of hard to argue that theory hasn't worked. And I think that theory is going to work exactly the same for the remaining companies in the fiber optic space now for the next half decade or so.
Now, have you gotten out of your Acacia position yet?
No, I actually haven't sold any of it. For one, I don't need to. I could write calls on it. I could, it's kind of what we talked about. I mean, I'm not 100% certain that, that nobody else can come up and make a compete. I firmly believe Juniper Networks really should make a run at them. Doesn't mean they will. It doesn't mean that, in fact, I doubt they will, because they probably should have been in there already. But I don't know. I mean, it's a very nice asset. Market cap's pretty low. The importance for the industry is very high, especially related to silicon photonics, which we talked about. I don't know. It's a pretty cheap price. I mean, so I'm not convinced that somebody else won't come along and make a competing bid. At the same time, I got a little bit of upside remaining in it. I'd probably be more, I kind of like, I just pretty much think I'll get 67 plus out of it, for one thing. And for two, I don't really need, there's nothing, I got plenty of cash, so I don't need Acacia to fund other trades and other positions I want to own. If I got to a point where I felt like, oh, hey, something is setting up super well, and I'm looking at 20, 30, 40, or 100% in front of me, I mean, I'll sell Acacia in 3 seconds. If I think I need to buy something else or short something else. But right now, it's basically a pool of resources that I have at my disposal. At the same time, don't really want to sell at 64.50. I mean, funny thing. I was actually almost bought more yesterday. Could have been a nice little clipper trade. I don't like doing 2 and 3% trades. I don't mind doing 4 to 6% trades, especially overnight. But I don't know. I mean, I literally was looking at 64.20 yesterday, just going, this is kind of dumb. I mean, this thing could catch a buck. I was kind of thinking buy at 64.20 and sell it at 65.50 plus. 65.50 to 66, because the stock will trade there again. I mean, my fantasy is that the deal doesn't go through. I mean, I would not mind it if the deal did not go through. Hopefully by that point I'd sold it all and then I get to buy it back again. But if the deal didn't go through, I don't think this thing go back to $45 at all. I mean, I think now people realize what the asset that Acacia is worth. I think it would trade pretty well. I mean, look at NXPI. It hasn't really hurt them. I mean, how long were they down after that deal didn't go through? I mean, it wasn't very long. You had a very short window to buy that stock. That was also kind of during a correction too. So, but anyway, yeah, no. I mean, I'll sell it at the right price, or I'll sell it if there's something screaming at me that I just think, look, I got to get a lot bigger in XYZ, and either I want to keep my cash position the same, or I want to get bigger in it fast. Acacia could go, but no, I haven't shed any. It's mostly just because I don't need to. I don't need the cash. I don't need to find a home for it. But yeah, it's nice to have a big reserve of capital sitting there available to use. It's the same thing. You don't want to be too complacent, because you don't want something weird to happen, like some kind of thing happen where a deal doesn't go through, and then, overnight it's down to like 52.
Well, that's where I think the risk is. That's where I personally think the risk is.
Hey, if I was real worried about that, it'd be gone. But
the way it's trading seems to be that the market participants think there's some risk there.
I don't know if I'd agree with that. I think the way it's trading it looks like there's more sellers than buyers of it. So people are kind of just saying, oh, it's bought. It's not really going up much more, so I guess I'll sell it and do something else with it. So yeah, I don't know. I mean, by the way, if I woke up tomorrow and it wasn't bought out, I honestly wouldn't mind. I mean, some people that would like ruin their day or week or quarter. Hey, I've done very well in this name. So if it were to drop 10 points in a morning, again, I would be happier if they were not selling to Cisco for $70, because I'm highly confident I end up making a lot more money on the stock over time. It might hurt, might sting a little bit on the portfolio value, but if you believe something you own is worth a lot more, you don't want it to sell. And that's my, I'm strongly convicted in that view that Acacia is selling at a terrible price. This is just like Mule. I mean, you remember we talked about, in fact, we might have been had a show or a radio broadcast literally the day of that deal or the day after that deal. You know, where would Mule be trading today? I mean, that, you know, talk about leaving money on the table. And I can go back to a lot of deals. I mean, I remember Arun got bought, Acme Packet got bought, same kind of thing. Acme Packet sold to Oracle in early 2013 at, guess what? At the start of the 4G cycle. And I was like, why are they selling at the start? And again, very favorable price. Oracle got a really good deal. I have no clue if Oracle did a good job running those assets or not, because they kind of got buried in a much larger company. But yeah, I mean, like I say, I'd actually prefer it if Acacia if something happened and the deal didn't go through. So I'd definitely be a buyer of it. I can tell you that. Oh, I wouldn't be a buyer of it like at 57. I'd probably be a buyer of it between 48 and 50 though. But yeah, I mean, you know, if I need the money, I'll use it. Right now, it's a nice position to be in, to not need the money and to have a stockpile of capital in excess of whatever. In fact, I don't think people think about that much. I think most people try to use like all their capital all the time. I think that's pretty poor trading. You should be able to make very good returns, you know, without maxing your capital or without levering yourself up fully. In fact, I would argue if you can't make decent returns without using up all your margin or all your available cash, then you're probably not trading very well. Your hit rate's not very high. Your success rate's not very high. You're not letting winners run. You know, you're probably doing lots of things wrong. So if you can't beat the market without taking way huge excess risk over the market, then you probably should improve your trading.
All right, so we have earnings season now underway. We don't have a ton of names this week, but what are some of those names that you're looking at outside of Netflix?
Well, so I mean, ADTN reports. ADTN is an interesting name because if this was a buck 50 lower, I'd probably be posting that I'm adding ADTN ahead of the print. I do have a small position. I largely closed. In fact, the last 2 quarter pops, I basically reduced my position down, very small, kind of placeholder. That's maybe a little more than placeholder position, probably like 2x placeholder. But small position. I had this quite a bit bigger last 2 quarters. They could have a good quarter. The only thing I don't like is when I liked it last 2 quarters, analysts, you know, had near abject hatred for it. I thought numbers were way too low. I thought forward numbers are way too low. Well, guess what? They've had 2 relatively good quarters. Analyst numbers have creeped up a lot now. So the bar is higher now. The stock price isn't way higher, but it's higher. But I'm more at this quarter. I'm not really looking at ADTN like as a name to really do a whole lot with. I like owning some, by the way. I like owning a small piece of this for the next year or 2. It doesn't bother me at all. By the way, that's a name probably could garner some M&A interest just thinking about it. But I think this will be a very good tell. I think the commentary out of ADTN could be very interesting for especially the U.S. Low Chinese exposure, low Huawei exposure names. So again, CommScope. There's quite a few of these, but I think ADTN, CommScope, maybe a Juniper. Put it this way: almost there's a few businesses that should be benefiting from the fact that Huawei's, you know, largely blacklisted. I guess they still are. They're less blacklisted now, I guess, than they were before. So, but the thing that hasn't changed, the thing that's been very consistent, is they are restricted from selling a lot of equipment into U.S. networks. So into U.S. 5G upgrades, U.S. telecom, U.S. cable networks, and they were a player. They were. I mean, you know, ADTN for 2 quarters in a row has talked about the fact that they're definitely increasing interest in the U.S. and EU at former Huawei shops. So that could be a long tail benefit for them. And, you know, if it's going to benefit Adtran, guess what? It's going to benefit COMM. It's going to benefit some other smaller players too. So the bottom line is, this is, you know, I'm more interested in the report probably on what they're going to, or what they say. They tend to guide pretty conservatively. So even if they do have a good number, they tend to guide. So they usually don't like post a huge guide. Another name that's interesting, again, I want to hear their commentary, is PLXS, especially since Arrow kind of made some negative comment. Arrow, so we talked about resellers one of the last couple times I was on. Arrow is one of those resellers. Well, Arrow, though, looks to me like their guide down really was actually pretty small. It was like a third to 50% less than most semiconductors have guided down. It looks like they're really getting out of a business, as they call it, their asset disposition business. That was probably a terrible business to be in. So, you know, that's when they're basically taking in used computers and mobility devices and things. And I guess they either get paid for it or they have to take it in and resell it. Maybe they buy it really cheap and hope to resell it higher. Tough business, bad business. I would not want to be in that business, because the value of 1-2-year-old electronic devices is just ever shrinking. But Plexus is interesting. I mean, Thursday is probably the setup to move the NASDAQ the most, just because, you know, Microsoft reports. But you do have Chewy. Chewy reports should be first quarter post IPO. You know, sometimes those are interesting. This is not a name I love, by the way, but I don't know. First quarter post IPO, yeah, odds of a beat probably pretty high. The problem is, who doesn't know that by now? Again, but you got CrowdStrike, which you know, could have some fireworks in either direction, and Microsoft. So at least you have a tone setter. And then honestly, a report that I'm pretty interested in, I don't have any at this point, but I'm even thinking about maybe some you know, not super short daily call, maybe like 1 to 2 to 3 month calls on it, is Schlumberger. So not a tech name. You know, tech is most of what I do, but not everything what I do. But I just think, you know, any of these oil companies, especially oil field service companies, again, just a weird spot in the market. You know, oil's not 35; it's closer to 60. In fact, it might even be. I haven't looked at an oil print today. It might be 60. You know, Schlumberger is definitely not trading like oil 60 or and higher. I don't know where it's trading. I don't know what it's thinking. You know, I don't. Some of these names are just so weird. But expectations are very low for Schlumberger, pretty low for the whole oil patch. So, you know, that's all interesting. It's kind of got my antenna up. I have started looking at some stuff for next week. Next week we get into it more, but I think I'll just stop there and just say that, you know, we'll just have to see. You know, does Microsoft have yet another quarter that's relatively benign and yet people buy it? That's probably what I want to see as much as anything. Is it like, look, is it a typical another Microsoft quarter? Which everybody seems to go gaga over, or is it a quarter where they like, okay, well, we've seen this a bunch of times, so what's next? And the stock's pretty darn expensive. So I'm kind of waiting to see, you know, what the machines, the algos, the institutional guys, you know, want to do with Microsoft at this point.
All right, TECHT. Well, I think that's a good place to check out for today, because that does set up for earnings, and we'll be able to recap some of those names: Plexus, Microsoft, Adtran, among some others, and then go through some of the earnings that are next week, because next week really gets things underway. So as always, TECHT, thank you so much for joining us today, and same bad time, same bad channel next week.
You got it. Have a good one.
You too, buddy.
Bye.